Thank you all for dialing in. We have a large number of people who have registered and we'll just give people a little time to come into the room. Due to the large number of guests, we will not be taking questions from the audience and would ask that you direct all questions after the call to your CBA Relationship Manager. I will now hand the call over to Simon Hunter, Managing Director, Business Banking Sales for Global Markets at CBA. Please go ahead.
Hi, good morning, everybody. Welcome to the monthly RBA call. We've been running these now for over a year, and it's been fantastic. We really appreciate so many clients jumping on the call and joining us for these timely updates. And I have to say, as these calls go, this last month has been a whopper. I was just looking, and the last call we did was on the 9th of March. And the following day, we all became familiar with SVB Bank. And then the following week, we had Credit Suisse and the other US banks. And amongst all that, we've still had the Fed, the Bank of England, the ECB raising interest rates. Tuesday, which we'll come to, the RBA paused for the first time with 10 consecutive rate rises previously. And then even yesterday, the RBNZ with perhaps slightly surprising 50-point raise. So an awful lot's gone on since our last call. So without any further ado, I'll introduce Gareth Aird, our Head of Australian Economics here at CBA, who will do his best in a very timely fashion to cover off a lot of what came out of Tuesday and what that might mean for the Australian economy and perhaps some of those other international aspects as well. Welcome, Gareth.
Thanks, Simon, and good morning to everybody who's on the call. When you rattle off what's happened over the last 4 weeks, it does sound like a lot has happened in a short space of time. And what's, I guess, in some sense unusual is that our central bank left the cash rate on hold while the other central banks, as you said, continued with their tightening cycle. The Reserve Bank on Tuesday left the cash rate on hold for the first time in the tightening cycle. We called that one correctly, as did most analysts, albeit there were still quite a few people out there that expected the Reserve Bank to raise rates again this month. They've delivered a lot of tightening in a short space of time, 350 basis points since May of last year. And the board basically decided that it was prudent to pause this month just to give themselves a little bit more time to assess the incoming data to determine whether or not raising rates further is the right policy response. So on that front, not only did they leave the cash rate on hold at 3.6%, but they did say in their forward guidance that further tightening of monetary policy may be needed to ensure that inflation returns to target. So what reading between the lines, what the Reserve Bank is essentially communicating to the market and to households and businesses in Australia is that if they're going to do anything in the short run on the policy front, it will be another interest rate hike. But they're not fully convinced at the moment that they need to do that. So they're essentially going to watch the data over coming weeks, heading into that May board meeting to work out whether or not they need to raise the cash rate again. The key data there that they will be looking for is the Q1 CPI. That is the most important data print between now and the next board meeting. We also get an update on the labour force, and that's a very important input as well. But the Reserve Bank is basically now of the view that they've delivered a lot. Monetary policy works with a lag, and there's plenty of tightening still in the pipeline to come through as those home borrowers who are on very low fixed rate loans roll off onto a significantly higher floating rate. So they're aware of that, which is why they basically wanted to pause this month. We should sort of add too that a pause is a pretty normal thing in a tightening cycle. If you look at all previous tightening cycles, this is the anomaly to the extent that the Reserve Bank has moved every single meeting up until this month since they started raising rates. Whereas in previous tightening cycles, what the RBA would do is raise rates, be on hold for a couple of months, raise rates again, and basically do it in a way that gave themselves kind of time to assess the impact of what they're doing as they're doing it. Whereas this time around, because inflation has been so high, they've moved very, very quickly. But now they've got to the point where they want to just give themselves a little bit more time to see the data to work out whether or not further interest rate hikes are needed. And on that front, Phil Lowe, the governor, delivered a speech yesterday, which is pretty timely given it came just 24 hours after their policy decision on Tuesday. And he basically took us through their thinking at the moment. And really that is that they're not in as big a rush to get inflation back down as some of the other central banks. They've kind of said if we can get inflation back to target by 2025, that's a job well done if we can keep the unemployment rate low. So that kind of contrasts with some other central banks that feel like they're in a bigger rush to get inflation back down. So Phil Lowe's basically said, we'll watch the data. We're not sure if we need to raise rates again. If we need to, we will. But we're also wanting to preserve those gains in employment that we've made. We've got a very low unemployment rate. That's a good news story. That's what he said, and we very much agree. But we still need to get inflation back down. So in the short run, what they're going to do is just watch the data, work out whether or not rates need to go higher. If the inflation data comes in a little bit stronger than they're anticipating, they'll raise rates again. We've still got one more rate hike in our profile, but they are aware that there's a lot of tightening still in the pipeline that will act to slow the economy as we go through this year. And they really don't want to engineer a recession, because that's not what we need. So that's probably a good place to pause, Simon. I'll pass it back to you.
Yeah, sure. Thank you. A very good summary as always, Gareth. Perhaps one area we might delve into first. It's always a popular conversation piece, but that aspect of house prices, and we've potentially seen some slightly counterintuitive data points in the last few days, and I just welcome your thoughts in that specific space, and perhaps just thinking at the broader piece. There's also some supply issues there. We've seen things around construction and property, and we're seeing immigration numbers at record levels as well. So just perhaps delve a little bit more on house prices specifically and where that presents a risk into the interest rate forecast.
Yeah, sure. Look, it is a little bit vexing to the extent that house prices actually went up in March, and in Sydney they went up a lot. They went up 1.4% on the month, which is a big monthly increase. And that occurred despite the Reserve Bank raising interest rates again in March, and that has further reduced borrowing capacity. Now, any kind of model would basically churn out a number which is still going down rather than up. And so in that context, it is very unusual to see house prices, having been in decline through the back end of last year because of the rate hikes, suddenly turn in March. You do get generally speaking, a seasonal strength in March. Coming into autumn, prices have historically been a bit firmer. But even then, even when you seasonally adjust that house price data, the increase in prices actually exceeded the normal seasonal strength. So it is a little bit of a head scratcher. I think what's basically happening is that because population growth is so strong, and because of the RBA's interest rate hikes, residential construction is coming off. You've got incredibly low vacancy rates now around the country, a very tight rental market, and that in turn is actually acting to support prices. And I think then thinking about it from a Reserve Bank perspective, the governor said this week that the decline in home prices is leading to a slowdown in household spending. In other words, a negative wealth effect is working to actually weigh on household consumption. That might have been the case up until this month, but if home prices pick up or at the very least stabilise, then you won't actually get that negative wealth effect coming through this year, and then that creates an additional complication for the Reserve Bank because they don't target home prices specifically, but they're looking at the housing dynamics through the lens of what does a change in home prices mean for household consumption, and if home prices aren't actually falling from here, then you're not actually going to get that weight come through on household consumption that you would normally get through a negative wealth effect. To be honest, it's a little bit of a mess right now in terms of what's going on in the housing market, simply because we've got very strong growth in rents, and that's going to continue through this year. That's something that the governor touched on yesterday, and yet raising interest rates cannot help that situation at all. All it does is weigh further on residential construction, and it reminds the landlords that if they're facing higher interest rates, to put up rents if they can get away with it. So it's definitely something that we're going to be watching, but I think from a policy perspective, it just further complicates things because the rate hikes aren't actually helping the rental market, and yet at the same time, rents are part of the CPI.
And here we are, potentially having consumers feeling like, well, if it's paused and we've come through the worst of it, then maybe that change in behaviour that was felt was required may not actually come through if we start to see that reversal of the house price piece, which feeds into that wealth effect, which feeds into consumer.
Yeah, look, that's exactly right. And I think on that score, we get an update on consumer sentiment next week. And I think it'll be really interesting to see what the consumer response is to the RBA being on hold this month, because we've seen over the past, for almost 12 months now, consumer sentiment printing at the kind of levels that have historically been associated with a major negative shock or a recession. And part of that is because the RBA has been raising rates so quickly, and a lot of households who have got debt have been quite anxious about where this is all going. And I think the fact that the RBA has paused this week is probably going to see some of that anxiety relieved a little bit for many households, because there's probably some light at the end of the tunnel here where they're going to think, oh, well, maybe rates aren't going to go too much higher from here. So we'll find out how the household sector is feeling next week about things, but it's probably worth keeping in mind that there are so many borrowers out there who are on very, very low fixed rates who have been insulated for the time being from rate rises, but as they roll off those fixed rates as we go through this year, they're going to face a substantial increase in their repayments, which is probably why they're not too optimistic on the outlook, simply because for their own personal finances, they know they're going to take a cash flow impact as we go through this year.
I might change tack slightly, Gareth, or wage price inflation. We've talked about it a lot on this call, has sort of maintained relatively stable over the period. We've talked a bit about immigration and the dampening effect that can potentially have on that. But bringing it perhaps slightly parochially to New South Wales Labor government where there's been some commentary around public sector wage negotiations. Could you sort of delve into that topic a little bit and what that might mean?
Yeah, it's a really important one. The outlook for wages is incredibly important when thinking about the outlook for inflation, and then by extension, the outlook for the Reserve Bank. One of the things that the RBA has leaned into to justify pausing the cycle and to justify why they don't need to take rates as high as some other central banks have done is the fact that up until this point, wages growth has been coming in consistent with the inflation target. And if you've got an inflation target of 2 to 3% with a midpoint of around 2.5%, what that means from a wages perspective is that wages growth in the range of 3 to 4% is consistent with that target, provided you get some productivity growth. And at the moment, when you look at, there's various measures of wages, but on balance, if you look at all the different measures, wages growth in the economy is tracking at around 3.5% through the year. And that is something that the Reserve Bank has basically said that's consistent with the inflation target, which is why they don't want the unemployment rate to go up in order to drop wages growth, because they don't actually think they need to drop wages growth. Now, the risk here is that while inflation remains elevated, you actually get wages outcomes coming in a little bit stronger than that, than the 3.5%, because the unions and workers, where they can, are pointing to the high inflation and saying, well, I need a pay rise broadly in line with inflation to make sure I don't go backwards. And that's where the RBA has talked about this risk of a wage price spiral, where it's a little bit of a chicken and the egg type thing, but basically that it's high inflation outcomes that generate high wages outcomes, and they in turn feed high inflation outcomes. Now, we're not in that place right now, and we don't think we'll get into that place. But that is a risk in all of this, that as we go through this year, as you said, we've just had a change of government, which might mean there's some stronger growth on the public sector side for New South Wales, that we end up seeing wages negotiated with the backdrop of higher inflation, and that in turn entrenches that higher inflation. As I said, we don't think that's the likely thing, but it's definitely a risk to our view, which is that the tightening cycle is pretty much done and dusted. But if those wage outcomes as we go through this year come in inconsistent with the inflation target, then the Reserve Bank will feel compelled to tighten policy further.
I might just take a slight international perspective, Gareth, from here. So we've talked a lot in the past in this call around the differences between sort of the US and Australia in terms of transmission mechanisms. But perhaps just looking nearer to home, MBNZ yesterday, 50-point rise. They're an early mover in the cycle, but sort of your takeaways from that and the difference we've seen in the two areas over the last couple of days?
Yeah, look, chalk and cheese, to be honest, between the RBA and the RBNZ. I mean, in the space of 24 hours, you had our central bank leave the policy rate on hold, which, some people had called for a hike, and they've sort of said, even though we've got high inflation, we're willing to pause in the cycle because of what we've done and the lags, etc. And then 24 hours later, you had the RBNZ surprise markets delivering an outsized 50 basis point rate hike. And the RBNZ governor has effectively said, we're just inflation fighters priority number one. We're going to do whatever it takes to get inflation down as quick as possible, and then we'll deal with the consequences of that after the event. So we've got very different approaches between two central banks, and a lot of the time I get asked the question, what do you think the RBA is taking from what the RBNZ is doing? And my answer is nothing. They're running their own race here. They're very different races, and they're very different policy approaches. So our Reserve Bank governors basically said, we don't want to crush the economy to get inflation down overnight. We're willing to take a kind of approach that means unemployment stays low and it takes a little bit longer for inflation to come down. Yet over in New Zealand, the governor has just basically said, well, we have an inflation target. We're going to try and hit it as soon as we can. And they're going to have a recession. So very, very different policy approaches. And I think you're probably looking at rate cuts that are going to have to happen in New Zealand because the Reserve Bank of New Zealand is going to take their economy into recession intentionally to try and get inflation down that bit quicker.
So bring it back to Australia, our domestic economy, just for the people on the call to really confirm, your central scenario remains unchanged from Tuesday, one final 25-point rise in May with a terminal rate at 385. That's your current view?
Yeah, look, that's right. We basically said heading into the meeting this week that we thought the Reserve Bank would leave the cash rate on hold, and we also thought they would retain a tightening bias. In other words, they say that if they're going to do anything in the short run, it's another hike. And that's exactly what they did, albeit they watered down that tightening bias a little bit. But they still basically said they're willing to raise rates further if they think that's needed to get inflation to target. So I think in that context, it makes sense to have one more rate hike in the profile. We put that in for May. If the CPI in Q1 comes in lower than the RBA was expecting, we'd remove that hike. But that's something we'll address when the inflation data prints. But at the moment, we think they've got one more to go, most likely in May, and then on hold from there until the back end of this year, where we've actually got interest rate cuts in the profile. Now, the governor yesterday said it's way too early to be talking about interest rate cuts, and I think that's the right thing to say when you've been hiking so aggressively and you still might have to hike in the short run. But we have to have a forecast that goes a little bit longer than the short run. And our thinking here is that by the time we get to the back end of this year, the economy will be slowing so much under the weight of this restrictive policy that with the unemployment rate rising, the RBA will want to not let that unemployment rate rise too much and actually end up delivering some cuts. Now, you need a few things to go right for those cuts to occur. You need wages growth to remain consistent with the inflation target, and you also need inflation to be coming down that bit quicker than the Reserve Bank is anticipating. So we're a bit of an outlier there, thinking we get some cuts later this year. It's very important for that call to come to fruition that inflation actually comes down pretty swiftly this year, and there's a key risk that it just comes down a bit but doesn't actually come down enough to get back to target and kind of get stuck at sort of 4 or 5%. And if that's the case, that the Reserve Bank won't be cutting rates, but that's our base case at the moment, that they end up putting through some policy easing later this year simply to preserve those gains in employment.
A slight left field question, Gareth, but there's a chance of a change of governor in the period and things happening around that process. Do you see that as relevant to a change in forecast or a potential change in direction in the second half of the year?
Look, it could be. You've got to say on balance that it feels more likely than not that we will have a change of Reserve Bank governor when Philip Lowe's contract is up for renewal. Now we do get the review of the Reserve Bank any day now. Basically, that review has been completed, and the government will publish their own recommendations based on that review. But you'd think on balance, we're likely to get a new governor, and that could slightly shift the reaction function of the Reserve Bank. I think it's fair to say that under Governor Lowe, the RBA has been sort of less proactive in terms of their policy setting. They've tended to move the cash rate based on lagging indicators of the economy. So they've been looking at inflation and unemployment to kind of work out whether or not it's the right time to cut pre-pandemic or to hike post-pandemic. And yet, if you're a forward-looking central bank that's setting policy based on your forecast rather than actual data, you would be moving a little bit earlier than what the RBA has currently been doing, both in terms of tightening policy and also loosening it. So I would say if we end up with a different governor who takes the approach that they're going to set policy based on their forecast, not on actual data, then that increases the chance, I think, that they cut rates earlier simply because they anticipate where the economy is going rather than waiting for the data to actually say this is where we've landed.
And you're not always entirely wedded to your predecessor's views as well. So.
That's right.
Awesome. Now, so I'm conscious that we sat here a month ago, or yourself and Chris were here a month ago, and none of us foresaw what happened over the next 4 weeks. We've deliberately focused this conversation more around the domestic economy and what's going on. But perhaps moving towards a sort of key takeout for people, we've a huge amount of volatility in the market over the last month or so. That volatility is continuing. We're seeing big differences between sort of economic forecasts, market pricing for hedging for corporates and things has moved around an awful lot. What would be your key takeout for our listeners here as we look at the next month ahead?
Yeah, look, good question. I would say the key takeout is that we are in a period of massively elevated uncertainty. There's so many unusual things going on right now, and it's still all a hangover from the government pumping in an incredible amount of stimulus to deal with COVID. And we've got a really unusual situation of an incredibly tight labour market, both here in Australia and in many jurisdictions around the world, and also concerns around the economic outlook. And it's very unusual to have such a tight labour market and also have so many economic commentators being concerned about the economic outlook, when if you're someone who's actually looking for a job or wants a job, it's probably never been a better time to actually get one. So we're in a very unusual period. As someone who's got to forecast things, and the team at the bank is trying to work out what we think is the most likely thing or most likely outcomes to occur this year, I would just say that we can't be too dogmatic about anything. We are in a situation where I think we need to listen to what anyone has to say on any potential outcome, because there is a lot up for grabs here at the moment. And we're in an environment of elevated uncertainty. I think it's just really important to be open-minded as to what sort of outcomes you might get. We're talking about interest rate cuts later this year, and it could be well be the case that the Reserve Bank is raising rates at some point later this year simply because they've underestimated the strength of the labour market and the strength of wages growth. So we've got a base case out there, but I'd say the range of possibilities to that base case is very, very large. And so I just sort of stress to anyone who's on the call, keep an open mind as to how things might evolve, because things are very fluid. As you said, Simon, in the last 4 weeks, so much has happened, and I don't think things are going to settle down anytime soon.
All right. That's I don't know if that's entirely reassuring for people, but it's very good insight, and I think it's probably reflective of what we're seeing in the market as well. Listen, thank you, Gareth, for sharing your insights as always. Covered an awful lot of ground. Big thank you to everyone joining us. I'll just give a very quick plug. Next month, we'll have a special federal budget addition to this call. So in addition to the timeliness after the RBA call, we'll also have Stephen Halmarick joining us on what the budget means for business institutions and households. So look out for the details on that one coming through. But beyond that, we're heading into a long weekend. We've had a pause on rates for the first time in 10 months. So I hope everyone has a lovely 4-day break and look forward to you joining us again very soon. Thank you all.
That does conclude our conference for today. Thank you for participating. You may now disconnect. 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 You may now disconnect.